All right, let's talk about silver. You've probably heard it called a safe haven, right? A super reliable store of value. Well, its history tells let's just say, a much crazier, more volatile story. We're going to dive into two absolutely spectacular crashes to see what they can teach us about how markets really work, about the power of a good story, and maybe most importantly, about the dangers of leverage. So let's get right into it.
Just let that sink in for a second. We're talking about an asset that people completely trusted. They thought it was real money, and it ended up financially wiping out almost everyone who believed in it. I mean, it sounds like a total nightmare, but this actually happened. It was all too real.
A 90% loss. Just think about that. How on earth could a physical asset, something you can literally hold in your hand, cause that much financial devastation? To figure that out, we've got to go back in time.
All right, so picture this. We're in the late 1970s. It was a time of serious anxiety. Inflation was just soaring, and people had this deep distrust of regular old money. It was, you could say, the absolute perfect storm for a silver frenzy.
And wow, what a frenzy it was. In just one single year, the price of silver absolutely skyrocketed. We're talking from $6 an ounce all the way up to nearly $50. That's an almost 8x return. And the story everyone was telling themselves, the big rallying cry, was simple but so powerful. Inflation is coming, the dollar is toast, silver is the only real money left.
But here's the thing. This incredible run-up, it wasn't natural. This wasn't just millions of everyday people buying in. No, this was engineered. And the masterminds behind it all? Two Texas billionaires with a very bold, and as it turns out, an incredibly risky plan.
So let me introduce you to the Hunt brothers. They looked around at the crazy inflation of the 70s, they saw people losing faith in the US dollar, and they decided, you know what? Silver is the answer. But their goal wasn't just to buy some silver. Oh no. Their goal was to corner the entire market. And to pull that off, they used a very powerful financial weapon.
And that weapon was leverage. Now, put simply, leverage is just using borrowed money, say from a bank, to multiply your buying power. It lets you make these huge, massive bets with just a little bit of your own cash. It's a way to go big. And the Hunts? They used it on a scale that nobody had ever seen before.
And just look at the sheer size of what they built. By using all that leverage, the Hunt brothers got control of over 100 million ounces of silver. To put that in perspective, that was more than a third of the entire world's supply at the time. A third! They had pretty much backed the entire silver market into a corner.
But here's the problem, right? When you build a giant tower on a foundation of borrowed money, it's probably not going to stand for long. The very same leverage that sent silver to the moon, well, it also planted the seeds for its own catastrophic collapse.
And the collapse, man, when it finally came, it was so swift and so brutal. Just take a look at this timeline. It peaked in January 1980, then the price started to crack. By the end of March, it had already been sliced in half. But believe it or not, the worst was still to come, and it happened on one single day that would go down in history as Silver Thursday.
So what was the trigger? Well, here's the crucial part. The commodity exchanges, they saw how dangerous the speculation was getting, and they just changed the rules. They banned trading on margin. That's the key, trading on leverage for silver. And just like that, poof. Anyone who had borrowed money to buy silver, and that includes the Hunts, was suddenly forced to sell to pay back their loans. In one day, the price got cut in half again, dropping from $21 all the way down to just $10.
So you might be thinking, okay, that's a crazy story from the 80s, but that was a long time ago, a relic of a different era, right? Well, history has this funny way of repeating itself, even when the characters and some of the plot details are a little different.
It's like they say, same movie, new story. The ending was devastatingly similar, but the story that got investors hooked on silver this time around, it was completely different. It was perfectly tailored for the 21st century.
See, this time, the big scary story wasn't 70s-style inflation. Nope, this time it was something called quantitative easing, or QE. After the 2008 financial crisis, the U.S. central bank basically printed trillions of new dollars to prop up the economy. And you know what? The fear was exactly the same as in 1980. The dollar is getting weaker, it's being devalued, you gotta buy silver.
And this is where the pattern really snaps into focus. Let's break it down. In 1980, the story was inflation. In 2011, the story was quantitative easing. See? Two totally different stories, decades apart. But the engine that was driving the bubble, it was exactly the same. Extreme leverage. And the result? Also exactly the same, a massive, devastating crash. The story changed, but the mechanics of the disaster, they were identical.
Okay, so that brings us all the way to today. And guess what? Once again, there's a really compelling story for why silver is a fantastic investment. And honestly, on the surface, this new story sounds more logical and more sustainable than ever before.
This new narrative, it's all about industrial demand. I mean, think about it. Silver is a crucial part of making electric vehicles. It's in AI data centers, it's in semiconductors, it's in solar panels. We're talking about huge, booming industries. So the argument this time is that the demand is real, it's fundamental. But here's the really important counterargument. Companies like Apple and Tesla and all those solar companies, they don't actually decide the price of silver. The price you see taking up and down on your screen every day, that's decided in the paper markets, in the futures markets. In other words, the leverage market. And hey, if you doubt that for a second, just think back to that 2011 crash. The iPhone was already a huge success back then. The solar industry was growing like crazy, but all that real industrial demand didn't stop a 70% collapse when all that leverage started to unwind.
So when you strip away all the different stories, the narratives of the day, a really clear, repeating pattern starts to emerge. And understanding this pattern, really getting it, is probably the single most important takeaway from all of this.
I mean, just look at the progression. Back in the 80s, the story was inflation. In 2011, it was money printing. And maybe in the near future, the big story will be about the green energy transition and AI. The point is, they're all powerful, believable stories that pull investors in.
And that right there, that is the core lesson. Whenever an asset's price gets totally disconnected from its fundamentals, and instead it's just being driven by a popular story and fueled by a ton of leverage, well, the ending is almost always the same: a very painful crash.
So at the end of the day, this isn't about me trying to predict where silver is going next. It's about understanding risk. It's about learning how to look past the really exciting stories and see the mechanics underneath. The real question you should be asking yourself isn't, hey, will I get rich off this? But rather, if the storm comes again, will I be able to survive it?